Good morning, good afternoon everybody. I hope that I have managed to make the technology work and that you can see and hear me. I'm very glad to be given the opportunity to participate in this webinar today, thanks to Switch Asia and to all the other participants. I'm going to start by giving a little bit of context to this discussion, and then I'll go into some of the perspectives from the Asia Pacific and a few case studies that specifically talk about SME financing. So let me start with this diagram, which you may find very familiar. This is from analysis that's been done by the Climate Policy Institute. And what they have found is that climate finance investments into clean infrastructure totaled $359 billion last year. Now this is encouraging, but as we all know, huge amounts of financing are required to meet the targets that we have all set. According to Ceres, with whom you may be familiar, it's a not-profit organization in the US, global investment in clean energy must be doubled to $500 million per year by 2020 and must reach at least $1 trillion every year by 2030 to keep temperature rises within the 2 degrees centigrade limit. Not all of this spending needs to be on power. Probably over half of the new investment per year to 2030 will be on energy efficiency, perhaps a third for low carbon transport, and 20% will go on clean power. Now this is a huge amount of money, but it is a small percentage of the institutional assets under management. There are possibly 120 trillion US dollars of institutional funds under management, as you see here, plus retail investors and corporate funds that potentially could finance the transition to a low-carbon economy in Asia and elsewhere. Now these large institutions, sovereign wealth funds, pension funds, insurance companies, on the whole are not currently investing in these assets. And here in Asia, we're no exception. There is a huge amount of wealth in this part of the world, assets under management. As you can see from this chart, we have 8 of the top 20 pension funds in this region, 4 of the top 10 sovereign wealth funds, and then what you don't see on this chart, 2 of the top 4 insurers, Japan Post Insurance and Nippon Life Insurance. So I think we all agree that the money is there, but it's not being invested at scale in renewables and clean technologies here in Asia for a range of reasons, which I would group into 3 categories. So first of all, investor strategy, capacity and behavior. This is really everyday, real-life, practical realities, I think. In many institutions, there is low awareness and there's little expertise with climate finance or investing in low-carbon assets. Even the term climate finance is new, and I think it can be off-putting. And we see examples where, in fact, some of the conditions really are quite favorable towards green investment, but it still doesn't happen. So, for example, in Malaysia, there is quite a generous government support packages for banks to lend to what they call green technology. But even so, this saw a very, very slow take-up in the market, simply because the local banks were not familiar with these projects, and it took a long time to come up to speed. Other sorts of financial institutions, pension funds, insurance companies, asset managers, they may also just not have the experience or the skills to think about these kind of investments. And many of them also have very short-term obligations that they have to meet. So for example, a pension fund, it has to make payments to its beneficiaries when they retire. And so it has to make sure that it balances its assets between liquid and illiquid assets like infrastructure. We talk a great deal about project structures and risk profiles. Global investors looking at emerging markets will have concerns about traditional cross-border risks, foreign currency, expropriation. They'll worry about the creditworthiness of the project off-taker, and they will also worry about specific climate or energy policy risk. Investors also need to understand the technology. They need to feel confident about the supply chain, the experience with servicing. And many of these parties in emerging markets are, of course, SMEs, and they may not have a long history of experience with these projects and with these industries. And some of their projects or their businesses are also clearly not very large, and therefore they can't meet the investment criteria of some of these large investors. And the third set of reasons, which I mentioned very briefly, global systemic issues. So we all know about fossil fuel subsidies, distorting markets, making it more difficult for clean energy to compete on price, and removing the incentive to use energy more efficiently. Now, realistically, I don't think we can expect this to change radically very quickly. I mean, governments in emerging markets especially have to deal with complex policy trade-offs, security of energy supply, access to energy, as well as environmental considerations. But this is a reality that project developers and investors need to try and work around. Similarly, regulation, both at the global and local level, does not always support a sensible allocation of capital to these kind of long-term investments. So I think we have to recognize all of these challenges to scaling up investment and lending, but I don't want to dwell on them any further now. We can maybe come back in the Q&A. What I wanted to do is to give you 3 very quick examples of financial structures that have been successfully used here in Asian emerging markets to address some of these issues. They involve both public and private sector funding, and they target SMEs, which are, of course, the entities which find it the most difficult to get funding even from traditional sources. So the first example is really an effort to give the most basic support for small-scale entrepreneurs in emerging markets. There tend to be very few support services, and seed financing is hard to secure. And this means that even very high potential renewable energy or energy efficiency sectors develop quite slowly. So this is an example of a facility that was developed by UNEP and 2 development banks in Asia and Africa to encourage the private sector to come in and provide seed financing for early stage clean energy enterprises and projects. This facility provides support in 2 ways. First of all, by providing grants to the potential investors for training, skills development, feasibility studies into the project. Now, these grants help the private sector investors, but they are contingent on them actually making an investment. So money getting to the SMEs. But sharing the transaction costs between the facility and also the private sector investor helps the investors to build up knowledge of these kind of projects and the kind of risks that they need to look at, and build a pipeline of potential small deals. And then, as you see, some of the capital is also provided for project development once the investment has gone forward. Here in Asia, this facility has been supporting 3 funds in Southeast Asia: Berkeley Energy, Allo Private Equity, and Armstrong Asset Management. So the second example looks at support for off-grid systems. These tend to be very small-scale projects, sometimes in isolated rural areas, which find it very challenging to raise investment capital. But as you know, these are the projects which may involve a large group of SMEs, both in the supply chain and in the downstream businesses associated with the projects. So this initiative, the PV Market Transformation Initiative, was designed by the IFC and Global Environment Facility to promote sustainable commercialization of PV technology in emerging markets. And the idea is to encourage the participation of SMEs in these connected businesses, such as sales, distribution, assembly, delivery, equipment service or consumer finance, so all the upstream, downstream supply chain businesses, and to help to create examples of successful, replicable business models that can be financed on a commercial basis by the local funders. And what this involved was funding, or is funding, capacity building and skills transfer with the SMEs, with the local lenders, and also through the facility a range of financial institutions may be made available, maybe equity, debt, and also concessional financing, which is designed to encourage participation by local lenders. And the aim of this facility, again, is to build the skills both in the SME borrowers and the lenders, which can drive a critical mass of transactions and over time create standalone commercial businesses. Now, the third example looks at what is called adaptation finance, financing activities that improve the ability of local communities to adapt to the uncertainty of a changing climate. And these tend to be communities that are very poorly served by traditional funding arrangements. So again, this is a program by the IFC and also the World Bank's Climate Investment Funds. They've been working in Nepal to encourage private sector involvement in improving climate resilience. So again, they are providing funding for training, for capacity development for the local SMEs. In this case, they are agribusinesses, to encourage those businesses themselves also to invest in skills training and assistance for farmers who are either their suppliers or their customers, to promote agricultural climate resilience in the region. And these agribusinesses might be interested in doing this, in helping the farmers, because more robust farmers as their customers creates the potential to sell a whole range of new products to them. It also creates the potential that they will supply higher quality and larger volume of crops further up the supply chain. So there's a commercial rationale for the businesses to become involved in this. And again, like in the last example, the fund provides a blend of financing instruments to encourage local banks to get involved to support these businesses. So what has been so successful about each one of these programs that I spoke about is that they've drawn in Asian commercial lenders who wouldn't otherwise develop the skills or have the appetite to lend to low-carbon businesses. There are other great success stories in the region. For example, UNEP did a project with two of India's largest banking groups, Canara Bank and Syndicate Bank, to provide consumer financing for solar home systems. IFC has worked with the Industrial Bank in China to provide loans for energy efficiency schemes. An Industrial Bank now has taken this on board to such a degree that it now prides itself on being, as it says, the greenest bank in China. So these are projects that leverage public money to create standalone commercial businesses. And a great deal more of this public money is now being dedicated to climate finance. The Fast Start finance, an amount committed by developed countries in 2009, was an amount of $30 billion mobilized for emerging markets between 2010 and 2012. And a lot of lessons have been learned from the deployment of those funds, which we can talk about later. And of course, the most recent and most significant commitment towards climate finance to date is the UN Green Climate Fund, through which developed nations will pledge $100 billion annually for climate-related activities in emerging markets. And the GCF has made a positive commitment to working with the private sector and again leveraging its public funds as efficiently as possible to facilitate investment by private parties. So that is what I wanted to talk about this afternoon, and let me just end with 3 quick points. First of all, I think we all recognise, as I said, that SMEs in general do find it more challenging to raise investment and debt financing than do large cap companies. Secondly, this is particularly so in the area of green finance, where a host of other issues come into play: lack of experience, new technology, difficult competitive dynamics. And thirdly, in the examples I've given, and in so many more going on around the region, we do see a promising focus on SMEs and on smaller local banks which tend to finance them. So there is enormous potential to scale up these activities involving skills transfer, real development of large pipelines, and cooperation between public and private sector. I look forward to hearing the views of my fellow participants, and I look forward to the discussion.